Let's look at how much I've lost in 2022 and also do a quick portfolio review. So I finally understand why people love flexing their portfolio during 2020 and 2021. Who doesn't want to look like a genius? And also, at the same time, gain more followings and views because of their quote-unquote superior picks. Like they always say, everyone looks like a genius in a bull market. But for context, in the previous bull market run, I was labelled as a clown the whole of last year because I was basically losing money perpetually, while everyone else was printing bank, mainly because a large percentage of my portfolio is congregated in Alibaba. And look at how far we've come. But there's been a great deal of investors that tried to outsource their responsibility to me and called me things like fraud, liar, or insert derogatory terms here. Laughing at people who invest in Alibaba while we have X, Y, or Z growth companies here that did a 3 to 5x already. So I definitely hope that you are buying the dip over the first half of the year so as to lower your cost basis, since it's such a great investment opportunity back in 2021. I believe in 2022 it will be the same. So it's also a great opportunity to help smash that like button. Don't waste any more time. Oh, and one more thing. Not sponsored by the way, but I know many of you out there probably have not maxed out all the available sign-up rewards. Currently, stockbrokers like Tiger, Moomoo, and even Weibo have extremely aggressive sign-up campaigns that gives you essentially risk-free return. Where can you get something like that? Moomoo and Tiger Brokers is giving out cash coupons and even free shares, and if you're lucky, you can get a free Tesla stock. While Weibo on the other hand is giving out $100 worth of Apple shares, and you shouldn't allow all these 100% ROI deals get away. I'll leave the link to all these brokerages in the description box down below. Now, you are here to see my losses. You'll have it. On the 9th of May, I uploaded a video titling my negative 35% Alibaba portfolio. It was pretty bad, negative 35% over a 1+ year time frame, not going to lie. 6 weeks later, on the 20th of June, I uploaded a video titling my negative 35% Alibaba portfolio is getting ridiculous. And spoiler alert, my portfolio was sitting at negative 24% then. In this video, I'm reporting an overall performance of negative 13% thus far. Negative 35 to negative 24 to negative 13 in a span of 2 months. So what happened? Long story short, Alibaba bounced pretty significantly again, which explains the portfolio movement. Don't forget, I'm at least 70% in Alibaba. I cheekily tweeted on the 27th of June, I guess China stocks are the real hedge to recession, inflation, stagflation, oil prices, war, etc. Then I get people immediately bouncing back. Yeah, sure, after dropping 80+%. So I don't know what he or she is smoking on, but the last I checked, the max drawdown was only 72%. And trust me, there are many companies out there still down more than 70% and don't seem to be hedging against the said scenarios. Now, I wanted to also take the opportunity to walk through with you my thought process on owning a particular position in my entire portfolio. As you can observe, my biggest position by far on a cost basis have to be the all-time favorite, which is Alibaba. So it makes up 73% of the portfolio. I currently have a cost basis of around $147 USD, quoting the BABA position, and I'm currently down around 18% on this Alibaba position. And sure, it could have been a lot lower. I'm not going to hide my incompetence of trying to time the market. It's a known fact. And my first buy-in was back in December of 2020, and I've been averaging down since then. That is more than 18 months ago. So for clowns that keep commenting that, hey, all you young punks have never experienced a real bear market before. The 2020 crash was not even counted. Wait till you see a real one. Firstly, I don't even know why is there a distinction between a real and a fake bear market. Secondly, please, I've been locked in my own bear market for more than 18 months now. You don't need to teach me what a real bear market looks like. Thirdly, I'm looking forward to how these clowns are investing in this current bear market. Let's see who live up to their own words of long-term investing and the perks of being an experienced investor, laughing at all the different youngsters and young investors out there. So I do, however, wish to admit that I could have done a lot better in terms of timing my entries for Alibaba specifically. Although hindsight is 2020, but given the sentiments and developments back then, I would have still started the position at the $220 range based on my then assessment. But I could have slowed down buying so aggressively on the way down, essentially catching the falling knife. so that I don't run out of ammo so quickly, so fast. I didn't manage to catch the bottom, but the lowest I caught was 100 Hong Kong shares at $86.90. It's a solid lesson learned, especially for future falling knives. So I'm not going to also spend more time belaboring the point on why Alibaba is a great investment. I've made at least 100 other Alibaba videos on this channel. If you just want a brief overview, I think this video about the bull and bear thesis around Alibaba is probably a good starter. So my next biggest position is actually KWEB, which is essentially a Chinese internet ETF, making up around 9.5% of the portfolio. So even though the conventional wisdom of an ETF is expected to be a lot more safer than stock picking, if you were to look at KWEB's top 10 holdings, it makes up at least 65% of the entire ETF, and they're essentially all Chinese big tech. You have companies like Tencent, Alibaba, Meituan, Baidu, JD, NetEase, etc. So no, I didn't buy KWEB to stabilize the portfolio. It's basically a sector bet. And if you haven't noticed already, I'm betting very big on Chinese tech specifically. So the thesis is simple. I think many of the long-drawn concerns around crackdowns and how China big tech will slowly become obsolete as the government continues to interfere is slightly unwarranted. But who am I to even say so? Random guy on the internet. Only time will tell, but of course, I think they will continue flourishing in the coming decade or so. So I've started a DCA into KWEB since late of last year. My first buy-in was around the $50 mark, give or take. I've put in around $500 to $600 monthly since then. So recently, however, because of the recovery in valuations, because they kind of bottomed out in mid of March, I'm near break-even on the KWEB position. So I will slow down my DCA to $250 per month instead. So I'll double it again if it continues crashing down. So I'm basically employing my own version of an enhanced DCA strategy, if you can put it that way. So my third largest position is Tencent. Okay, by now you should already know that I'm a CCP spy. I work for the Chinese Communist Party. I'm basically donating all my money to China. Jokes aside, I've been accumulating Alibaba for the last 18 months because from a risk-reward perspective, Alibaba seems a lot more attractive than Tencent. They are both great businesses, by the way, in my own humble opinion. Recently, however, Tencent is also experiencing some sort of pressures from both regulatory approvals and also the dripping of shares from its largest shareholder, which is Prosus. And it's currently providing a very interesting opportunity for me to start a position, which was what I did. So of course, I'm going to jump in. I'm not going to wait for the Fed to do a U-turn, Chinese government to start supporting them, and then start moving the goalposts again, etc, etc. I'm going to make a separate video on why I bought Tencent, so subscribe if you want to watch that. So following which, I have a 5.1% exposure to Meta platforms. So bulls of Meta will think that it's an opportunity of a lifetime. Bears of Meta will think that this is a dying business. There is no middle ground. Don't bother sitting on the sidelines. So the bottom line is quite simple. If you're not excited about the next stage of development between reality and the virtual world, or i.e. the metaverse, like however they want to call it, then I don't think you should touch Meta, not with a 10-foot pole. After learning my lesson from Alibaba, cheap can always get cheaper. Nobody dictates how cheap can it be. Hence, I'm spacing out my buying and I just want to accumulate more as long as my price target hits. So Meta will be a growing position in my portfolio as long as it keeps collapsing and if I think that the business fundamentals are still intact. Next, I have an equal weightage of VT, which is an ETF, a Vanguard Total Index, and Taiwan Semiconductor at 1.8% of the portfolio. So for VT, it's a simple $250 DCA every month, just to act as a benchmark comparison. So it's not going to move a needle in my portfolio because as you can see, it's only 1%, so it's not going to be anything substantial. TSMC on the other hand is a slightly trickier topic. I know how everyone will start hounding about the Taiwan problem, about the upcoming CHIPS Act, and how everyone is going to make it extremely difficult for TSMC, both China and US. So to be very frank, I of course have my own read of the entire geopolitical climate. If not, I wouldn't have 90% of my portfolio in Chinese companies. So I'm currently a lot more concerned about the business fundamentals and also expanding my own circle of competence into the semicon industry. It's not going to be easy. I'm not going to smoke you guys as well. I can't suddenly turn from a China expert to an e-commerce expert to a cloud expert to a social media expert and then straight up becoming a semiconductor expert overnight as well. It takes time and I'm still learning. I'll be sharing my thoughts and reflections over time, so do bear with me. So TSMC is a starting position and I'm excited to learn more about the technicalities. Lastly, I have a 0.1% exposure in Amazon. So this is also a starting position to quote unquote force me to start studying Amazon's business model. And I've put it off for the longest time ever because it has always been perceived as being expensive. To add on, out of all the US big tech companies, it does seem like Amazon and Meta has lost their story, which made me even more intrigued, especially to keep up to my falling knife nickname. So do leave in the comment section down below what your portfolio makeup look like currently, and I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!